Welcome to Words of Stardom. This is CH. I will be covering the Algebris Financial Credit Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. Algebris Investments is a boutique asset manager founded in 2006. It is privately owned by David Serra, who is the founder and CEO of the firm. Algebris is headquartered in London and mainly operates in various Europe major cities, although it does have sales offices set up in Singapore, Tokyo, and Boston. Algebris specializes in European financial institutions, in particular bonds across the whole credit structure. That being said, it has in recent years tried to expand its offerings beyond that to global equities and global bonds, and even private markets. Algebris currently offers 7 UCITS funds and 1 private market fund. While there is no information on the firm AUM, adding up all the fund sizes gives about 24 billion euro in total. The Algebris Financial Credit Fund that is covered in this video is the flagship product of Algebris, given the fund alone takes up 16 billion euro of AUM. The Algebris Financial Credit Fund is a sub-fund under the Algebris UCITS Funds plc fund family. The fund family is set up as an Irish investment company with variable capital, or ICVC, structure, and is UCITS qualified. The fund is registered as a MAS restricted scheme, which means it is suitable only for accredited investors. Therefore, you may find the fund appearing in some of the distributors' product offering list, but not immediately accessible unless you disclose your accredited investor status. The Algebris Financial Credit Fund is co-managed by Sebastiano and Bruno, and further supported by 3 investment analysts. The fund webpage provides very clear information on the whole investment team, with their photos available and bios readily accessible by clicking on each name, including the analysts. There is even a broader web page that provides the same for all the business development teams in the different offices and middle and back office teams. The effort to provide this information translates to the respect given by Algebris to each member of the firm, and is rarely seen from most other fund providers. I really like this and hope more fund providers can give better credit to their people behind the products. Sebastiano is the lead manager for the fund. He joined Algebris in 2012 as an investment analyst and was instrumental in the launch of the financial credit strategies and making it successful throughout the years. He is now also the firm's CIO and as well as the head of financial credit strategies. Bruno joined Algebris in 2019 and started co-managing the fund since then. He brings with him substantial European and global financial sector experience from various past fund providers he worked in. The Algebris Financial Credit Fund provides the investment objective and a brief description of the investment approach in its fund webpage. The aim is to achieve a high level of current income, followed by a modest capital appreciation. This gives a sense of either the portfolio investing mainly in higher yielding exposures, or that the fund provides share classes with high distribution yield, or both. Capital appreciation would be a secondary objective. The rest of the description essentially talks about what the fund will invest in. There are subordinated and hybrid bonds issued by financial firms, primarily those identified as global systematically important financial institutions, or G-SIFIs. Hybrid bonds include Tier 1, Tier 2, contingent convertible or coco bonds, and preferred shares. These are more complex exposures and financial terminologies that some investors may not understand. Therefore, the fund is categorized as a MAS restricted scheme for accredited investors only. Let's spend a few minutes to understand what these investments are. Here is a simplified capital structure illustration that I obtained from VanEck's website. The capital structure essentially refers to the different sources of capital for a company, ranging from the different types of debt or bonds down to equity shares. The capital structure determines who is safer on the list, i.e., who gets more recovery when a company becomes insolvent. For example, a senior bondholder has a higher likelihood to recover more monies compared to an equity shareholder who will typically get nothing back if a company goes bankrupt. As such, the amount of risk and return also typically follows the capital structure, with equity shareholders typically having the highest return potential, but also get significantly more volatility and risk than others. Non-financial companies will typically issue only senior debt or senior bonds, as well as common equity shares. You can see even senior debt is further split into different layers in the capital structure, so be mindful when you invest in direct bonds as well. Financial companies such as banks and insurers also issue hybrid bonds because they have additional regulatory requirements. By calling them hybrids and with them sitting in between the normal bonds and equities, you know that they are not to be treated the same as normal bonds. This is exactly what the Algebris Financial Credit Fund is primarily investing in. There are many financial education websites providing details, so I will not elaborate here. This is an extract from Investopedia, where you can see that hybrid bonds are basically used as emergency capital, whereby it is possible for these hybrid bonds to lose part or all of their value when they are being used by the company to absorb losses during critical situations. Hybrid bonds are further split into Tier 2 and additional Tier 1 or AT1 according to regulatory requirements. The handling of AT1 capital is also different across regions. In the US, companies issue preferred stocks to cover AT1 capital requirements. In Europe, companies issue contingent convertible or coco bonds. Coco bonds are named this way because they automatically get triggered when the company's capital fall below a predetermined threshold, where then the coco bond either gets converted into common equity, or gets a temporary write-down on its value, or gets a permanent write-down on its value. Here is a summary table from PIMCO comparing some of the key characteristics across the capital structure and also showing the differences between US preferreds and Europe AT1s. Interestingly, while these hybrid bonds have the additional and differentiated risk compared to normal bonds, these risks do not translate into low credit ratings. You can see in this same table that Tier 2 and US preferreds typically still has BBB investment grade credit rating, while Europe AT1s can have a mix of BBB investment grade rating to BB non-investment grade rating. Investors therefore have to be careful not to confuse these bonds with normal investment grade bonds. I personally do not agree with this, and I would treat hybrids like high-yield bonds because of the additional risks involved. Some investors may assume these are generally safe investments because banks don't normally get into trouble easily. But extreme events do happen, and they can happen very quickly. The most notorious event relating to hybrids in recent years is the collapse of Credit Suisse in 2023, that led to a full permanent write-down on the value of its coco bonds. While this was controversial and investors are still trying to take legal actions, it does show that hybrids do have significant risks embedded within them. So, with these explanations, hopefully you have a better understanding what this fund is investing into. And I again suggest that you treat this more like a high-yield bond fund investment in consideration of the risks involved. Let's go through the fund prospectus next to understand the investment objective and strategy better. The prospectus first covers again the scope of the underlying investments that we went through earlier. It is also mentioned here that the fund can invest indirectly through ETNs and ETFs, which provides some flexibility, although I haven't really seen the fund utilize this. There is also a mention that the fund can invest substantially and without any limits into bank deposits during high market volatility environments, which is important as the fund is focusing in a very specific subsegment of the bond market, and there is no other way to diversify the market risk away during a market crisis. The prospectus provides some brief information on the investment process. It is mentioned here that the portfolio construction involves both top-down macro assessment and bottom-up bond picking. The top-down assessment considers prevailing market situations as well as a variety of macroeconomic risks. The bottom-up selection process involves fundamental analysis of individual bonds and also a review on the value and economic prospects of the issuer companies. There is also a paragraph providing more insight in different conditions to take positions, with a list of specific conditions that helps to show that looking out for opportunities is an important skill in investing. While not stated here, it is mentioned earlier in the fund webpage that the base currency of the fund is Euro. That being said, the fund has a global mandate and can invest in bonds denominated in all currencies. This follows with a pretty long section talking about the usage of financial derivative instruments or FDIs in the portfolio. The fund can use, for example, leverage hybrid bond ETNs as part of the portfolio investments, although there are specific limitations including max 130% net long exposure, max 100% short positions with no net short exposure allowed, and max 100% leverage of the NAV. We will see later if the fund discloses actual derivative usage information in the portfolio. One thing missing is a benchmark or a target return for the fund. I find this important because it would be difficult for investors to figure out whether the fund is doing good or bad without something to compare against. Let's look at the actual portfolio next to understand what the fund really invests in. The Algebris Financial Credit Fund was incepted in 2012, giving it about 13 years of track record now. Fund AUM is decently large at €16.1 billion, and as mentioned earlier, this is the flagship product and core competency of Algebris. Portfolio information is available in the fund fact sheet, where it shows country and capital structure breakdown. Here, we can see that while the fund has a global mandate, it is primarily invested in European AT1s. This is expected as the team is based in Europe and their core expertise lies with European financials. Additionally, the AT1 market is larger and has higher return potential than Tier 2s. Therefore, it is common to see funds of such strategies having significantly more AT1 exposures than Tier 2s. While the top 10 issuers list cover the leading European banks, the fund portfolio actually has 44 issuers and 182 bonds, so it is well diversified enough to reduce single issuer and issue risk. Average credit rating is at BBB, although as mentioned earlier, I think hybrid bonds have their own specific risks and therefore should be treated the same as high-yield bonds regardless of their credit ratings. Effective duration is not high at only 3.1 years. This is because while AT1s are perpetual bonds, they have a call date typically in 5 to 10 years of issue. Yield to call and yield to worst are at 4.7%. That doesn't look excessively high and suggests the fund doesn't just go for the highest yielding bonds in the market without risk considerations. In any case, we will see how this matches with the payout yields of the distribution share classes. We can get a bit more portfolio information from Morningstar. Here, it shows again the fund is almost fully exposed to Europe. We can also see the bonds are mainly BBB and BB credit ratings here, as there is no credit rating breakdown available in the fund fact sheet. We can also see that the weighted coupon as per Morningstar data is a high 6.92%. That shows AT1s have generally high coupon yields. However, because the AT1 market is not cheap price-wise, the resulting yield to call and yield to worst looks less appealing at 4.7%. As the Algebris Financial Credit Fund is the flagship product in the firm, it is quite widely distributed globally and comes with a long list of share classes. For the purpose of this video, we will focus on the retail R and A share classes. R is the original retail share class that is more commonly offered in the region, with the US dollar classes launched in 2014 and Sing dollar classes launched in 2017. A is the newer retail share class that is launched in 2023. As the fund is base currency in Euro, all non-Euro share classes are currency hedged. The fund offers various other currency classes besides US dollars and Sing dollars. Distribution share classes are available across the different currencies and have a quarterly distribution frequency. We will go through the distribution yields in a while. R classes have a 1.2% management fee. Adding other expenses gives a total expense ratio or TER of around 1.28%. There is also a 10% performance fee that we will go through shortly. The newer A classes have a higher 1.35% management fee, but has no performance fees. We will compare the resulting performances of the R and A classes later. As this is a MAS restricted scheme, there is no PHS document, and therefore the trailer fee information is not available. However, it would be typical for fund providers to share around 50 to 60% of the management fees as trailer fees to distributors. Distributors are allowed to charge up to 3% subscription fee for R classes and up to 5% for A classes. Although given this is a bond fund, I think 1% or less would make more sense. Some distributors may also offer the institutional I share classes that have a much lower 0.5% management fee. This would be the cheapest share class if you are able to access it. We hardly see performance fees in mutual funds, so I want to take a quick few minutes to explain how fees work in general with a simplified example. Let's say you subscribe to the fund that has an NAV of $100 at the start of the year. The distributor bank charges a 1% subscription fee, so you pay $101 in total, where $100 goes to the fund. Assuming 1 year later, the fund generated 10% gross return. This means the fund is now worth $110 on gross basis. Now, assuming this is the R share class that has a 1.2% management fee that calculates to $1.32. This is essentially the salary collected by the investment team. There is also another 0.08% other expenses paid by the fund to other parties such as custodian and auditor and operational costs, etc. All this totals to the 1.28% TER. In reality, the TER is actually being factored into the NAV calculations daily, so it is kind of invisible to investors. Funds without performance fees normally stop here, with the resulting net worth being a net 8.59% returns gain in the fund. There is a lengthy section in the prospectus that elaborates on the performance fee calculation of the fund. But let's continue using the same simplified example to explain this. For performance fee calculation, there is a term called high watermark or HWM, which is basically the highest value of the fund in the previous performance calculation period. The fund uses an adjusted HWM, which is basically the highest value net of TER. For the purposes of this example, let's assume that the adjusted HWM is $102. Meaning the fund went up to as high as $102 before coming down to $100 at the start of the year. Let's also assume that $108.59 is the highest adjusted NAV for this performance period. With a 10% performance fee on the outperformance, this calculates to $0.66, which essentially is a performance bonus given to the investment team, just like how most companies pay year-end bonuses to good performing employees. This $108.59 will then become the adjusted HWM for the next performance calculation period. So, after reducing the performance fee, we get a final NAV that is $107.93 that translates to 7.93% net return for the fund. In reality, the performance fee for the fund is actually being calculated quarterly and accrued into the NAV calculations daily, so it is also kind of invisible to investors. The final step is distribution payout for distribution share classes. Assuming the fund provider decided a 5% distribution payout that will calculate to $5.4. This means the remaining net returns would become the net capital gain into the NAV. That would in turn have a final value of $102.54 instead. For the Algebris Financial Credit Fund, the reality is that the distributions are calculated and paid out on a quarterly basis. Hopefully, this example gives you a better understanding of how fees work in a mutual fund. The Algebris Financial Credit Fund doesn't seem to provide distribution yield data in its webpage or factsheet. Morningstar, however, does have recent historical distribution information available across the share classes. As mentioned earlier, the fund has a quarterly distribution frequency, and we can see here that the fund does not have a smoothened payout policy, although the payout amounts do not deviate significantly over time. Taking reference from the 12-month yield data in Morningstar, the R share classes currently have around 5.4% to 5.5% payout yield that looks to be more similar to the gross yield of the portfolio. With about the same payout yield between the US dollar and Sing dollar classes, this also means the currency hedging costs are factored in the NAV instead of the distribution. The A US dollar class, on the other hand, has a slightly lower payout yield of 4.88% that looks to be more similar to the gross YTC or YTW instead. Taking the RD US dollar share class that has the highest distribution yield as an example, we can see in this Morningstar chart that the share class NAV has essentially been hovering quite close to the launch NAV, meaning almost all the returns over the years have been paid out as distributions. I think Algebris is managing the distribution yields quite decently, as there is no notable NAV decline in the past decade, despite going through periods of market stress. As usual, I would personally prefer the accumulation share class instead, for long-term compounding growth if there is no need for income payout. The Algebris Financial Credit Fund provides a pretty comprehensive performance table in the factsheet that includes returns for calendar years, 12-month rolling periods, and annualized across various time periods. Unfortunately, the fund has no benchmark defined that we can compare against to understand whether these performance numbers are good or bad. That being said, there are still some insight we can gather from this performance data. Looking at the 5-year and since inception annualized returns, we can estimate that the long-term expected return of the fund to be around 6% per annum in US dollar terms. This again is more in line with the return expectations of high-yield bonds. We can also see that the fund can be quite volatile in shorter term periods, as per exhibited in the 12-month rolling returns of as high as 18.5% to as low as minus 13.8%. So investors need to accept such potential volatile returns when considering this fund. Let's run some Morningstar comparison charts and start off with the currency share classes. As the fund is based currency in Euro and has most of its portfolio exposures in Europe, there is a positive currency hedging effect for the US dollar and Sing dollar hedge share classes that has turned out to be quite significant over the years. Next, we take a look at the newer A retail share class that has a slightly higher management fee but no performance fee versus the R share class. We can see that since inception in 2023, the A class has delivered a slightly higher net return than the R class. This may be because the fund performance has been quite bullish during this period, and the performance fee in R class would have reduced the net returns more noticeably. This is, however, non-conclusive, as we will need to see how the A class will turn out on a longer time period across market ups and downs. In any case, the A class is available for investors who do not like the performance fee concept. But how does the fund stack up against the bond markets? Here is a chart comparing the fund versus passive ETFs representing global investment grade bonds, global high yield bonds, and European AT1s. We can see that the fund has managed to outperform all the rest quite comfortably. Additionally, we can also see the fund had performed near identical to the Invesco AT1 ETF most of the time, but held up much better with less drawdowns in 2023 when the collapse of Credit Suisse happened. This shows that the active management and the risk handling in the fund worked out well and helped to reduce the losses. On a related note, it is also useful for investors to appreciate that the hybrid bond market tends to be less volatile than broad corporate bonds during normal times, but does come with its own specific market risk. As hybrid bonds are a rather niche market, there are not many established funds available for offering in the region. The most popular peers would be PIMCO Capital Securities that has a similar overweight to European AT1s, and Principal Preferred Securities that is more tilted to US preferreds. In any case, Algebris Financial Credit looks to have clearly outperformed on long-term basis. With that, let's summarize our findings. Algebris is a European-based boutique investment manager specializing in financial sector and in particular financial credits. The Algebris Financial Credit Fund is their flagship product and is one of the most popular solutions covering hybrid bonds, especially European AT1s. The bios of the managers and investment analysts are readily available in the fund website for investors to understand and appreciate the credentials and experiences of the people involved in the fund. This is a pretty straightforward product that invests in global hybrid bonds and in particular a heavy bias in European AT1s given the expertise of the team. The investment strategy provided is brief, but I think is sufficient. Of course, it would be even better if Algebris can provide more details on its bond selection process and its risk management approach. The fund, however, doesn't define a benchmark or target return, which makes it difficult for investors to assess the performance of the fund. The fund has a decently large AUM of over 16 billion euro and has more than 10 years of strong track record. Portfolio, while concentrated in European AT1s, is also well diversified on both issuer and issue aspects. This is one of the few mutual funds that still has performance fees. That may be a concern for some investors. While I don't disagree with having performance fees where it makes sense, the fund has nevertheless launched newer share classes without performance fees to tackle this. Distribution share classes appear to have payout yields decently high, but without incurring notable NAV decline over the years, which is good. The strong performance of the fund is a key selling point. The fund has shown to outperform other active mutual funds as well as passive ETFs in the same category. In conclusion, the Algebris Financial Credit Fund is certainly a strong performer for accredited investors looking to participate in hybrid bonds, especially European AT1s. This market segment does come with its own unique risks and volatility, so investors should understand the market segment before making an investment. On a related note, this also means that the fund is more suitable as a satellite or tactical investment, instead of a core bond exposure in the portfolio. This concludes my absolutely biased comments on the Algebris Financial Credit Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.